and we'll be getting straight into business. But I just want to lay a bit of a foundation for some of the conversations we'll be having this morning. This discussion is at an important intersection of financial services industry, regulation, technology, and even customer expectations. And that's because everything is kind of evolving simultaneously, and financial institutions like yours are increasingly expected to adapt to all the three at the same time. And we know that across Nigeria's financial sector, we are entering what many observers are describing as an era of hyper supervision. Regulators are now asking deeper questions, expecting faster reporting cycles, and requiring institutions to demonstrate stronger governance. And that means that a lot is demanded of our institutions, of everybody who plays in the compliance operations roles in these organizations. And in this year alone, we've already seen a wave of regulatory developments that affect how financial institutions should operate. And from monetary policy tightening, liquidity pressures, even as recently as yesterday, we still saw something around the anti-money laundering policy that has just come out from CBN that requires that every bank needs to kind of automate that system. These are some of the things we'll be discussing this morning. And each policy, well, they may look manageable, but when it comes to the real deal of making them work within our system, there are certain things we need to pay attention to, especially from an infrastructure point of view. And these are some of the things that we'll be discussing this morning. How to get operational alignment with what the regulator is really, really asking for. And for us here this morning at Peerless, we work closely with financial institutions across the ecosystem to kind of manage regulatory change most effectively and ensure infrastructure readiness. And that's why we have this conversation this morning. We have with us this morning somebody from PwC who has long played like a central role in advising financial institutions, regulators, and government on governance, risk management, financial transformation, and regulatory compliance. And their insights often help shape how institutions interpret policy and translate regulatory expectations into practical operational frameworks. And this morning we have Gbenga Adepetu, who is partner and finance advisory lead at PwC, joining us this morning. He brings deep experience advising financial institutions across strategy, finance transformation, regulatory readiness, and his work with banks, regulators, and financial service providers gives him a unique vantage point on how policy changes translate into real operational challenges within the industry. So, Mr. Adepetu, thank you for joining us this morning. And we'll be listening to him very shortly. And also with us this morning is the CEO and co-founder of Peerless, Dr. Joachim Adenusi. He's a globally respected strategy and risk professional who has advised governments, regulators, and corporate boards across the UK, the United States, the Middle East, and even Africa here. He's a former director of the UK Institute of Risk Management and a recipient of the UK Risk Manager of the Year Award, among many others. And he has spent decades helping institutions design governance structures and operational systems that enable resilience in complex regulatory environments. Once we've listened to Gbenga this morning, Dr. Joachim would also kind of take us a step further by examining some of the operational risks associated with the policies that Gbenga will be discussing, and most importantly, the practical solutions financial institutions like yours can adopt. So it's going to be a 60 to 90 minute session in total that is insightful. And I want to encourage everyone to please pay close attention and also have your questions ready, because we will also create time to answer them. So without further delay, it is my pleasure right now to invite our first speaker. Please join me in welcoming Mr. Gbenga Adepetu, partner and finance advisory leader at PwC. Gbenga, the floor is yours.
Thank you very much, Olumide, and good morning to everyone. Good morning, Olumide. Good morning, Dr. Adenusi, and good morning to the audience. I'm sure.
Morning, Gbenga. Thank you.
Yeah, thank you, and I'm sure that we're going to have an exciting time this morning. First and foremost, just to confirm that everyone can hear me clearly. I'm trying to share my screen. Can we all hear me clearly, please? Just to start from there.
Yes, loud and clear.
Okay, excellent. Now, the next point is to confirm that you can see what I'm sharing right now. Is that clear?
Yes.
Okay. Great. So I like to do it this way. If you've got questions or comments, please just you can just pen it down, and then I can take it after the session. But as I know that I've got about 40 minutes or thereabout to discuss this, so you'll see me maybe not just pacing at a speed that I believe will be comfortable for all parties. But if you're struggling with any area, you might just want to quickly interject so that I can take my time. So thank you very much. When I received this particular topic, Coalition of Regulatory Enforcement and Customer Expectation in Nigeria 2026, the financial sector. First thing that came to mind is that it's really a coalition, because if we look at how what customers are demanding, what customers are asking from financial institutions across board, we'll see that customers are basically demanding a whole lot more. And of course, just as customers are asking questions, asking for better services, asking for efficiency, we also saw the regulatory body. And the regulatory bodies, not just one of them, several of them, all looking like they're all trying to outdo each other, coming up with regulations every now and then. And one thing we've also seen is that beyond the new regulations that are coming through, even regulations that are old, we are seeing that we are seeing that they are trying to really enforce them. So without much ado, this morning it's a pleasure to be with you, and I've basically put my presentation in these four agenda points. Just give us an introduction of what exactly are we saying, talking about these regulations and customers. Where do we see a coalition? What do we mean? What are we talking about? And then I would quickly go and just quickly look at the regulatory landscape. I will not spend a lot of time here because as people who are operating in this space, I believe we all understand that. And then I will look at the financial institutions landscape, look at the different financial institutions, the different players, and the key gaps. Basically, what are the gaps that is driving this regulation? Regulation don't just happen. Something basically leads to it. So what are the gaps that the regulators have seen in the operations of the financial institutions that has led to some of the regulations that we are seeing, and even this heightened enforcement that is going on there. And then the last bit is to talk about the readiness requirements, for financial institutions. Whether we like it or not, the regulators, the financial institutions have to respond to the regulators. Of course, in responding to that, it has implications for business, for the economy at large. So we'll look at that. So basically, these are the four agenda points that I'll be taking us through this morning. So let's get into it. First and foremost, the year 2026 seemed to be, that year of compliance, right? It looks like that year where every government agency, they're trying to outdo each other, like I mentioned earlier, right? Trying to ensure that whatever policy they've had in the past, right? It is this year that everybody's looking to say, oh well, now we need to begin to enforce it, and we are seeing a convergence, right? Because we are seeing all these regulators, all of them, before now they used to work in silos, right? But now we are beginning to see a whole lot of data sharing amongst them. We are seeing a lot more collaboration going on between them, and that's of course from the regulator side. We are seeing they've enacted some stricter policies, stricter penalties They are deploying technology, deploying AI to ensure real-time monitoring. Okay. On the other hand, customers are asking for seamless, better service, faster services, digital. Everyone seems to be savvy with technology these days, and they want services on their palms, right, and on the go. And all this, right, is creating, is giving the financial institutions that a headache to say, okay, I need to respond to the customers. However, at the same time, there's the regulatory compliance that is there, and the reality is that one must not come at the expense of the other, right? So financial institutions, have to balance all these things to be able to satisfy the customers, manage their costs, continue to stay profitable for the stakeholders and all. And that's where we see the collision, which we have decided to give the topic of this presentation this morning. Now, but what is changing and why does it matter, right? And you as a financial institution, what should we be doing about it? I've tried to break this down into 5 areas that we'll be looking at this morning. First and foremost, we need to understand the regulatory landscape that we're talking about, right? What is the intent, right, behind some of these new regulations? Even the existing ones that looks like the enforcement, right, are beginning to become tighter. The penalties are now going to be implemented. Maybe in the past there would have been waivers, but now the government is waking up and the regulatory bodies are waking up to say we need to implement these things. So we're going to be understanding that. Then the next thing is to examine how these regulations are going to be enforced, right? The tools, the patterns, what methods are going to be used to hold financial institutions accountable, and would from there I try to identify the gaps and risk, right, that some of these regulations are trying to address, right, what that has made these regulations necessary. And then we'll assess the impact on customers, and not just customers, what is also this impact of all these regulations on the financial institution as a whole, as themselves, and then the economy at large. Whether we like it or not, right, they have far-reaching implications on the Nigerian economy. We'll assess. We'll do an assessment of that quickly on this presentation, and then finally, what should financial institutions do, right? What must they begin to demonstrate, right, to ensure to give comfort to stakeholders, to give comfort to their shareholders, to give comfort to even their customers, right? That they are prepared to ensure compliance whilst remaining profitable and addressing customer needs. Now, what I've tried to do here is to just try to put the financial institutions in the middle and try to say, look at just a few. I've just put a few of these of the regulators on this slide, with the CBN, the NICOM, SEC, the NCC, pensions, the Nigerian Pensions Board. We also have the Nigerian Revenue, the Nigerian Revenue Service. And just to mention a few that I've just put in here, and each of them, they have their roles which they carry out. Now, to achieve customer satisfaction, I would expect that financial institutions must align their operations and technology, right, with their core drivers of customer experience. Whether we like it or not, the winner in the financial institution space, right, is that particular institution that can ensure that the customers' needs and customer satisfaction is placed at the top, very top, right, of their priorities, in terms of their priorities. When customers are happy, when customers feel fulfilled, then of course they will definitely deviate towards you, right? And so, looking at the customers sit at the core, and whether we like it or not, customers, whether individual or businesses, they all demand common things, right? Whether it's about speed, they want services to happen almost immediately. They want to call you and they want you to respond almost immediately. They want trust. They want to be sure that when you say whatever you tell them, you keep to your words and you make it happen. Even when there are issues, right? Those issues can be resolved, in in the best possible way, and of course without much damage or hurt to their financial standpoint. They also want transparency. Okay, so whatever it is that you have promised when they were signing those dotted lines, you keep at it, right? You make it very clear your product terms, and you know your the terms of the product. They want that to be clear. And on the final note, they want safety, and of course, along with that is privacy as well. They want to be safe. They want to be sure that their phones are always protected with you, and of course their data, their information is something that is private and not available to the public. So having said that, with the customers, you see that the customer needs, when you now put that side by side with the requirements of the regulators, you see that huge collision. And whether we like it or not, what the regulator is asking for, can lead to a number of things, whether we would like it or not, because cost, for example, compliance cost could be, whether you like it or not, the financial institution would like to push it to the customers, right? And this could begin to erode things like trust, right? It could begin to impact even time. The regulator will be asking for more information. The regulator wants you to do things at a slower pace, right? And the customer is saying, I want it faster. Now, this ultimately will lead to this financial institution also, losing things, whether revenue, whether reputation, operational stability. A number of things could be affected, right? And that's it. Now, if you decide to do that trade-off and say, oh no, I want to respond to my customers very quickly, then there's also that threat that the regulators could feel like they're losing control, right? And then public trust, if they're not able to do their work and they're not able to enforce. So you see, there's that push and pull situation going on between the customers and the regulators, and the financial institution is sitting in the middle. And of course, finding that balance and the best way to manage all this is critical. And so I asked this question, which is critical, which I believe every financial institution will be asking: are we compliant? Right, and that which is what we used to ask ourselves in the past: are we compliant? But today it's basically going to be changing, right? And the question everyone needs to be asking is: my operating model, right, that I have today, the way I have set up my system, right, whether people, technology, processes, right, is it able to produce compliant outcomes, right, at speed? Okay, meaning, am I able to respond to the regulators quickly, right? And then, of course, depending on how many of them are on my case at every point in time, right? I have maybe quite a number of them, right? And I'm sitting there. Am I able to, use the same data to be able to respond to multiple requests coming from the different regulators, right? And I'm also able to show the evidence clearly, right? And that's going to be, the critical question that should be asked, right? And I think answering this question, right, we must also answer the question of customers, which is: am I also responding to my customers and meeting their needs, and am I still competitive? So that's the question I would like to just respond to as I go through this. And so in this second section, I just want to talk about what is changing, basically. What exactly is where are we moving to? And what I've tried to do is that the essence of these regulatory bodies, like we all know, and we agree, is basically to preserve our financial system stability, right? Ensure that our markets retains its integrity, protect customers and investors in the market, right? And enhance fiscal accountability, whether we like it or not at the end of the day, right? And so it is important that monetary policies are implemented, right, correctly and and often. And that's why you see every now and then we see releases coming from some of these regulatory bodies that impact our monetary environment, impact our fiscal environment as well. We are seeing a whole lot of things going on, even talking about our telecommunication infrastructure, because it looks like that's basically the backbone of many of the financial institutions operate. That is becoming critical. We are seeing that together, all these institutions which we have talked about, NITDA, the Nigerian Insurance Commission, National Insurance Commission, the Nigerian Revenue Service, all of them, right, they make up the backbone of Nigeria's financial and economic, oversight architecture. And so it's important, right, that, all these guys work together. And what we are seeing right now is that we are beginning to see an integrated approach, right, in their supervision. Unlike in the past where everyone is requesting for data, we're now seeing them, having that integration, right, using digital channels, requesting the financial institutions, implement digital platforms to enable them, monitor things on an ongoing basis, right? And that is what we are seeing that is driving, this that's going to drive the regulatory environment in this year 2026. Okay. Having said that, this is just talking about what each regulatory body does, and I will not spend too much time here. But here, what I've tried to do is to, try to put in three distinct things, right? What is shaping, this the regulatory direction for 2025-2026, and you will see in the first bucket there I've got customer-focused regulations. The second one, economy-focused regulations, and then the last bit, which is processes and systems. So across these three areas, right, all the regulations that is coming through, they will fit into one of this, somehow, right? And talking about the first one, customer-focused regulations that tend to protect the customers from, exploitation, from abuse, from losing their funds, right? Taking advantage of the customer, or you're just ensuring that the customers are protected, in one way or the other from fraud and the rest. The second one around economy, right, is basically to ensure that, our economy remains strong, right? The economy is not exploited, which we've seen in the past, right? That we continue to maintain monetary discipline. We have a resilient financial sector and a stable economy at the end of the day. We have regulations in that area. And then the last bit are regulations that are focused on, the strength, right? Internal structures, internal control systems of our financial institutions. So these three, basically, is these three areas is basically where every regulation that has come through sits in. And here I've just tried to break it down for that, just talking in details about some of these regulations. So for the CBN, for example, we have some of the regulations which has come through around customer protection regulations, the 30-second refund rule. We have the guide to bank charges. All these from the CBN are geared towards ensuring that the customer is protected. We've got the economic focused ones like the 45% cash reserve ratio, which I'll talk a little bit more about down the line. FX market unification, the bank recapitalization, which is a big one. All that focus on the economy. So let's look at for example, the NICOM, for example, market conduct guidelines focused on customers, claim settlement guidelines. Some of these, guidelines are all they're customer focused. Then we have the revised capital requirements as well for the insurance entities. That is also focused on the economy. And then in terms of processes, talking about premium collection and remittance rules, licensing and renewal rules, and a number of guidelines for infotech operations and all that. On the PENCOM side, in fact, one of the things that has come through there from the process area is around data recapture, which is happening, micro pension, report integrity, revised ICT guideline for pension operators, and all that, and all these regulations, whether we like them, like I mentioned earlier, you can just pin them to any of these areas as we go. But looking at the timeline in terms of how our the regulation has evolved, regulation environment has evolved, you'll notice that between 2020 and 2022, right? If you look at the number of regulations that I've put there, and then compare that to between 2023 and 2025, right? You will see a lot of activities. You will see that the regulatory bodies have become a lot more active, right? And in fact, the year 2025, if you it's almost between 2025 and 2036, the regulations that have come through is almost swallowing up everything else that we've had in the past. And guess what? Even some of these ones that we've had in the past in terms of enforcement and, really, implementing some of the policies, the year 2025, 2026, right, is seeing a marked change and a marked difference in that. So in terms of evolution, in terms of activity, right, in this space, we're going to see a lot more in 2026. Okay, and what I've tried to do is to just tease out the 9 key regulations, right, which I believe are the driving force behind what's going to happen in 2026. Okay, basically what I've tried without putting them in any particular order, right? I've just tried to educate us a little bit about some of them, which I believe we might know. The first one is the 30-second refund rule, right? For this one, it's basically talking about whatever you think about it as using the telcos, right? The telco infrastructure, using it for airtime or data, purchases and all that, right? And because this rule, which the CBN has come up and the NCC has come up with a framework to say within 30 seconds, if there's a failed transaction, it must be reversed immediately, right? And the regulatory intent is basically just looking at efficiency, customer satisfaction, trying to restore strong trust, right? And system, and just put some integrity in the system. So this is gearing towards real-time reconciliation. So like in the past, where you expected to go make complaints, begin to somebody begin to do some manual reconciliations before it is approved, before it is refunded. The CBN, NCC are saying financial institutions must create platforms such that within 30 seconds, this rule, reversals, right, or refund must happen. Now, what has happened is that SLAs, standard SLAs, have been developed, right, and these SLAs have to be monitored, and where there are breaches, then of course there will be consequences as defined in the regulation, right? The other one is bank recapitalization, which I'm sure is one that we're all well aware of, and this is basically saying all banks, depending on which tier you fall into, have to recapitalize, and they've given some timelines for this to happen. And already this basically is to ensure that we have stability in our banks. We have which will eventually transform into having a more stable financial sector, having a more balanced and resilient economy, right, once our financial institutions are strong enough. And so this particular one, of course, the enforcement modalities, which we all know, the CBN, right, is big on this one, and they've given a window. At the end of those windows, we would expect to see either banks being downgraded or license being withdrawn completely. I move on to the e-invoicing one, which is a big one. The Nigerian Revenue Service, as we know, has rolled out this particular one, and this impacts tax, right? And this one expects businesses across board to get on government approved digital platforms and use that for transacting with their customers, as per from a revenue standpoint. And here government expects that they will be able to monitor activities on an ongoing real-time basis, right? And basically they want to be able to track and basically the integrity of data, basically, is what this will, and of course ensure that government does not continue to lose revenue, block all gaps and leakages from this area. And here the enforcement modalities is, I think this one is even straightforward, because government is upfront accrediting fintechs to develop and deploy these compliant invoicing systems and platforms. And those platforms are expected to meet certain requirements in terms of regulation and security, and and of course to be enforced online real time, and they expect that the financial institutions will help in carrying this out. Right? We have the ICT guidelines for pension operators, right? And this one basically to the pension, to the PFEs and the custodians as well, right? And this is to ensure that they are basically in how to manage their technology systems. This is basically what this regulation is talking about, right? How pension data, must be guarded, how pension assets must be protected from cyber attacks, system failures, just putting in place, standardized ICT practices across, our pension operators across Nigeria. And that's the intent of this one, to ensure that, they can also provide digital services to contributors, and also ensure that, all data in there is secure. And how they will monitor this, I also expect this to be online real time. And of course, there will be continuous and periodic checks, on the pension players. And where there's any gap, or there is any non-compliance, then of course there will be penalties, as the case may be. We've got the cash withdrawal limit, which has been on for a while, and I believe we all know that. But I quickly want to go to the 45% cash reserve ratio, which is the one the CBN has also insisted on. And if you think about it, looking at how inflation has hit us, over time, last year, 2 years ago, and up to last year, our inflation numbers were trending in the 20s. But I think with this new regulation, we're beginning to see some results coming through, with our inflation rates, slowing down, going down. Also trying to tighten liquidity to stabilize the exchange rate. We are beginning to see some stability, in that space. And the CBN is, they're not joking about this one, right? You just have to meet that ratio. You have to abide by this ratio. The SEC rules update. This came through sometime last year in 2025, and here we are beginning, as we've seen, the government, right, also putting out rules on corporate bonds, on how equity funds and other collective schemes needs to be managed. They put guidelines in that space, and basically it's just to make sure that they can regulate the private debt issuance, making sure that SEC has clear oversight over some of these things. And of course, any non-compliance will be met with serious sanctions, as the case may be. Now, there's also a combined recapitalization, around whether we talk about the capital market players, PenCom, the insurance companies. Every one of them has seen some form of recapitalization, right? And they've given a time frame for compliance. Of course, if that doesn't happen, then of course there will be consequence around that. The last one is one on corporate governance, and as you know, corporate governance has been around for a while. But what we're saying is that it's an ongoing activity. Every now and then you see a few changes being made to the requirement. Now, this next slide is what I've just tried to do to say where exactly is the heat map, right? The heat, put a heat map with the pressures, right? Which of the financial institutions are which ones are most impacted, right, by many of these regulations. And if you look at the color code I've used there for the keys, I've tried to say red is high pressure, orange medium pressure, green moderate or very low pressure. But if you just take a look at it for this first and second slide, you can easily see that the deposit money banks is basically the ones facing the highest. The fintechs, followed by the fintechs and the microfinance banks, and then you see the other players coming on board. So in terms of pressure, in terms of the guys who are facing maximum pressure, simultaneous exposure to for 5% CR, the tax that I mentioned earlier, instant the AML, anti-money laundering enforcement, and the customer conduct super, all sorts. The DMBs are the ones with the highest impact or largest impact, and so it is expected that they will continue to they'll be resilient enough to handle all these pressures that will be coming from multiple regulatory bodies at the same time. Now, let me go over to I would try to move on from this because I think I've explained this earlier in terms of what does it mean. But let's go to the landscape. Now, looking at the landscape, what I've tried to do is to put them in about 6 buckets. We've got the insurance and pension. Yeah, for interjecting. So we've got the insurance and the pensions in one bucket. I put them in the deposit money bank.
Gbenga, you're muted.
Gbenga, you're muted.
Gbenga, you can unmute to speak now.
Okay.
Yeah.
Okay, can you hear me now? Good, thank you. I didn't know that. Okay, so I was just saying, on this page, I've tried to put the different players in the financial sector into about 6 pockets, and I'm sure as a player in the sector, you can fit into one of these areas. Okay. And of course, what I've just tried to do here is to look at the different revenue model that we operate, the customer base for each of the players, the deposit money banks. Basically, their money is largely from interest and fees, sometimes from FX trading, and then of course the customer base, digital service providers, majorly also from transaction fees. They get commissions at times. Microfinance bank, interest as well. DFI's interest. Capital market institutions, brokerage fees, management fees, that's where they are. And then they have different customers, ranging from individuals, HNIs to institutional investors. Insurance, they make their money from premiums, pension fees, and basically. So that's what I've just tried. Now, here I'd like to just pause a little bit and talk to us about the root cause, right, that prompted these regulatory actions. I said earlier that regulations don't just come. Sometimes it's an event or a happening or a pattern, right, that basically leads to why regulations will happen. And what I've just tried to do is to say this, put them in basically 6 areas, basically the root causes. And the first one is around weak governance. Most times when you see an organization where there's that very poor governance oversight, especially from the board or from those charged with governance or those charged with management, and then when those failings happen, then you see a regulation coming through. The second one is capital inadequacy, and I think this one explains itself, right? You have to an organization has to be strong enough. It has to show that it has the financial muscle to stand in the face of shocks and risk and unforeseen circumstances. The third one is unreliable digital transaction systems. Today, we know there are so many systems out there. Systems people are building systems every day. Applications are being built, but whether those applications are reliable, whether they're strong enough, is another question that needs to be asked. And so that is another reason why regulation has to come. Just to make sure that we do not we protect our assets and we protect our data. The fourth one is around cybersecurity and ICT vulnerabilities. Closely linked to the number 3. If your system is not robust or strong enough, then of course it's open to attacks, from cyber bullies and cyber tips. And so it is important that regulation helps in a way to protect the customers and also protect the organization. Over reliance on physical cash is another one. Where cash transactions happen a lot, then of course things are more difficult to track, right? So regulations has come in that area as well. Then unregulated capital market activities, our capital markets, it's important that we protect it to avoid any crash in there. So basically those are the reasons, and whether we like it or not, each of them has got cost to customers, cost to financial institutions, and to both of them. Weak corporate governance will impact the customers, it will impact the financial institutions, and so the regulation has to come out to address them. So what I've just tried to do is to try to link each of them to, the cost to customers, what can happen where they're not, where these things happen, and then the cost to the financial institution and the regulation that is addressing that. So for over-reliance, on cash, that's we know. Regulated capital markets, money is invested with no oversight or disclosure, and this can create problems with customers. Where so many, and these days we hear of so many of them, right, who are carrying out all sorts, and they disappear with customers' money. So all that we needed regulation, set rules, and had to be firm, be stricter to ensure that you can protect that. And in terms of cost of financial institutions, market credibility, capital inflows will shrink, and the rest of it. Now, I want to quickly jump. I can see my time is running out. I want to quickly jump to what most financial institutions do. Right, we've talked about all these regulations and the cost impact, right, on customers, on the bank, on the financial institution itself. But what is the readiness requirements for financial institutions? What do we think they should be doing? And I put that in 3 buckets as well. First and foremost, around the capital adequacy, what must be done, right? What should they be looking at doing at the moment immediately? The second one is around failed transaction resolution, and the last being cash management. And for the first one, which is around, I believe this must have been done by many of the financial institutions in terms of capital adequacy, gap analysis, just trying to see where you are today and where what the regulation says, and even doing that assessment and even putting a buffer ahead of it to say, okay, what should I do? Find a way to activate capital raising strategies where there are gaps. Evaluate options like mergers and acquisition, as an option, and that should come early rather than waiting, because the very good guys, the very good people might be taken off the table by the time you think you want that option, and even there's nothing wrong in also considering whether you need to reconsider your license and all that, and clear communication to your stakeholders is important. In terms of failed transaction resolution, I believe with this one, technology has to be put in place, right? Gone up days where reconciliation machines are, they are unable to respond promptly. With the advent of AI, I believe many of these challenges that we used to see can be taken care of. So financial institutions need to begin to think about implementing reconciliation engines and systems that can proactively, right, resolve the issues rather than be doing that retrospectively. Your core banking applications and payments, infrastructure, switch infrastructure they need to be revisited and looked at, to see how you can upgrade them and make them a bit more reliant. And of course, with the CBN, and the other regulatory bodies, and trying to enforce SLAs, right, service level agreements across board. And it's important that you also find clear ways of monitoring this and measuring them and ensuring that you're on track with respect to that, right? Cash management being the last one, I will just quickly move on so that okay. I think I've spoken to this, right? Yeah. So what I've tried to do is just take some of these regulations and try to say what must the bank, what should the bank be doing, right, to ensure that quickly they are ready, right, for this enforcement drive that will be happening, especially as it relates to some of this regulation, right? Because whether we like it or not, these regulations will impact the customers. Like I said earlier, 45% cash reserve ratio means that you have lesser funds to play with in terms of giving loans to customers and all of that, and that will impact lending rates, which we are already experiencing, right? And of course, customers will shy away from taking loans, which somehow will impact your revenue. So banks must look for ways, to either diversify, right, their revenue streams, right, offer structured lending products, and other methods that they can think of, right, to ensure that they address that. Talking about the 30-second rule, I think I've talked about that. Technology upgrades with robust testing capabilities needs to be put in place. Online real-time applications that can quickly resolve those matters without any form of manual interactions need to be put in place, right? We've talked about bank recapitalization. I've talked about that earlier. Corporate governance, what you must do, e-banking platform invoicing. Then, of course, this particular one since it's something very new, I can bet that it will test the resolve of many of the financial institutions, right, to be able to respond to this. And so we need to provide some form of training, right, some form of clear paths, right, to how to address this, because I expect we're going to have some teething challenges at the transitioning phase, right, which will require very robust systems to be able to respond to that. At this point, I think the regulatory expectations are clear. The path forward is very clearly defined. The regulatory bodies are resolute. They are determined, and the question is, the financial institution that can quickly execute these changes, right, without sacrificing customer satisfaction, sacrificing profitability, sacrificing efficiency, they are the ones that will stay on top. So I just want to say a big thank you for listening to me, and I'm available for questions as always. Thank you very much.
Thank you very much, Gbenga, for that wonderful session. Yes, please give him some digital applause. I can see. Thank you all very much. That was really insightful. You've taken the time to take us through the entire process end to end, the gaps that led to these regulations. In fact, you've kind of opened this further than we expected, looking at the entire ecosystem. And you told us some of the pain points that these compliance regulations have created for, or will likely create for customers, and how banks can mitigate them, which is very critical. And I like the way you ended it to say the banks that can execute quickly without compromising on customer experience, profitability, and a couple of other things are the banks that will stay ahead. And I'm sure that a lot of the institutions that are here on this call listening are taking notes. And that is just one bit of the conversation this morning. Please, if you have questions, kindly just jot them. We will be getting to them, before we leave here this morning. Over the next couple of minutes now, I would like to invite our CEO and co-founder here at Peerless, Dr. Joachim Adenusi. I gave a brief profile earlier on. I would just quickly like to do that again. Dr. Joachim, are you ready?
Yes, I am.
Awesome.
Can you see me?
Thank you. Yes, I can see you.
And can you hear me?
Loud and clear. All right.
Thank
So
you.
that's Dr. Joachim. Once again, he is our CEO and co-founder here at Peerless. Dr. Joachim is a globally respected strategy and risk professional who has advised governments, regulators, and corporate boards across the UK, the United States, the Middle East, and here at Africa. He's a multi-award winning risk management professional, and he has spent decades helping institutions design governance structures and operational systems that enable resilience in complex regulatory environments. This morning, Dr. Joachim will be taking us through just some of the things that Gbenga has already, created a foundation for from a risk point of view. And you as an organization, how do you prepare from a technology point of view to execute just like Gbenga has advised? And Dr. Joachim, over to you now. Thank you very much.
Thank you very much, Olumide. Good afternoon, colleagues. Good afternoon, everyone. I think it's afternoon now. Distinguished executives, colleagues and partners, good afternoon. Thank you very much. And to my colleague from PwC, Gbenga, What an amazing presentation. Thank you so much. I loved it so much. And thank you for that amazing presentation. I'm not even sure whether there's anything I can add to it, but perhaps I'll just make one or two comments and contributions, and then we can open the floor for question. You can see what Gbenga's approach to this. One of the things I want to start with, for me, I'm passionate about recurring problem. And if you're close to me, you'll have heard me talk about why do we allow the same thing to happen over and over again without actually specific intervention. He mentioned something about weak governance. And maybe that's what I want to start about. When we talk about weak governance, we've talked about this corporate governance thing. We mentioned governance everywhere, every time. But the issue about governance is not just the time itself. It's about what actually we're doing about it. First, one of the things that financial institutions we have to pay attention to is the fact that we've been on this path before of regulatory changes. We've been on this journey so many times, from Sanusi to Soludo to different regulators, and they'll come with major landmark memo. And the memo on Monday can transform everything on Tuesday. Actually, could change our operation. We know that. But the question is, are we learning from the past? And are we allowing the same thing to happen again? Are we pausing? Are we imbibing the culture of foresight and anticipation? And that's what really, really the concept of governance and risk is about. It's about that foresight. It's about anticipation. It's about accountability. Who is accountable? Who is responsible? Is someone paying attention? And I hope today that we're all paying close attention to what we're sharing here. And we can go back and start looking at the implications and look at what have we experienced before, where are we now, and what's coming. We have the beauty, we have the opportunity to anticipate now. We are aware from Gbenga's presentation that 2026 is going to be intense. Regulators are converging. They're coming together. We now know what NIM is going to be used for, the tax reform. We're aware that, you know, when you open your company, your TIN is your task. It's your task also number now. So we are aware of some of this convergence coming up quickly. So that's telling us that it's not going to be business as usual. These changes are coming fast and coming deep as well. So let me just address some of the things that perhaps we need to focus on. I don't know if I can see me properly. So for many years, we treated regulatory changes as interruption. That's what we've done. They've started again, they're stressing us. Occasionally, we try to jump over it. We look for loopholes, we look for something to do. But this time around, I'm not sure whether there's going to be a way out. And it's becoming obvious. We operate in a market where we know that our regulators are very powerful. We can do anything with us. If our smart organization, we start engaging with regulators earlier, or we start kind of trying to sense check what the direction they're going. But let me go to financial services. If our banks, banks that struggle are not the ones that lack smart people. That's one thing I want to say. Not that they're not smart people there. There are. They're the ones that are fighting this dynamic reality with static tools. They have tools that are outdated. They have systems that are patching. They have methodologies that kind of archaic. And the smart guys are struggling to juggle between modernity and the archaicness of the tools that they are running as well. So we focus on initial expensive change request with foreign vendors. A lot of vendors out there providing tools. You wait for weeks, also possibly some of the issue, wait for weeks to deploy, the issue of support. In the meantime, we hire more operational staff to bridge the gap. We look at technical experts to help us. And this whole thing creates a cycle where compliance becomes biggest operating expense, because the capacity, the availability, the context, the understanding, the support, the expenses, and the difficulty of getting the right people to help us actually putting pressure on the speed at which we can comply. So the challenge for 2026 is that the policies now require real-time technical execution. The regulators are asking your systems to behave differently and instantly. I'll quickly address some of the specific policies mentioned by Gbenga earlier on with focus on technical implications. For example, on the new cash withdrawal limit, CBN. And so let me talk about what I refer to as risk. Risk is not something that has happened. We're anticipating a potential threat or a potential opportunity. And I just want to clear that out. And it will have major implications on our passion, what we want to deliver, our profitability, our sustainability, our ability to deliver what we promise our customers, and expectations from the customers as well. So the threat here is the fragmented data. The regulator sees one customer. If your ATM system doesn't talk to your branch system in real time, you will accidentally allow breaches. That's a major subconscious compliance issue, right? And what we need is a single view of customer that updates instantly across all channels. The solution I'm proposing this morning is that your infrastructure must support dynamic parameterization. You should be able to change your withdrawal limit from the admin console and have it to reflect on every ATM nationwide in seconds, immediately, without writing multiple lines of code to be able to update it. So you find that there's a solution. On tax administration, for example, IFRS, the threat here is legal exposure and customer trust. Becoming a tax recovery agent is dangerous if you get it wrong. So most banks are tax recovery agents, right? Deducting the wrong amount or freezing the wrong account destroy trust and invite lawsuits and litigations. So what solution am I offering here? You need an automated rule engine, something that is nimble, flexible, adaptable. The system should receive the instruction, validate the debit against the account balance, place a line for the only amount, and then generate audit trail without human intervention. That's what we did. And all these capability tools, system supports available now to us at neither rate in Nigeria. We can do it. We can afford it. And we can actually start implementing it now. Also, on the 30-second refund and customer protection, the threat here to the organization is operational drag. Refunding failed. Gbenga explained this extensively. Refunding failed transaction manually is a relic of the past. It's kind of a dinosaur historic way of doing banking, to be honest. And the 30-second mandate effectively bans batch processing for reversal. So what do we do? What solution can we offer? Banks need an event-driven architecture. The moment a transaction fails at the switch, the core should trigger auto-reversal immediately, and speed is now a compliance requirement. So you can see some of this we're building, that we are creating solutions to proactively prepare ourselves, to proactively position the organization to take advantage of meeting the speed, also meeting the customer requirement. Yeah, so that we can come to that balance comfortably. Right. So you find that these are some of the things that we have seen, right? So on the capital hikes and mergers, the threat here is data migration failure. For those facing consolidation, the biggest threat isn't raising capital, it's merging data. And in data migration, migrating legacy data where the customer records get corrupted is an issue. So what's the solution? We need a neutral, agile integration layer that can ingest dirty data from multiple legacy sources, clean it up, map it to the new standard efficiently. So whatever category you find yourself this morning, my strategic advice is that let's stop building for the rules, right? Let's build the rules. Let's build something that will sustain us over a long time rather than trying to have a short time gain. Something that will help us to withstand the pressure and will give us resilience. The only certainty that the regulation, will keep changing. So we need something more robust. We need something more sustainable. So maintaining a rigid legacy core, core banking now, referring to, requires a lot of dollarized amounts. We know what's happening with the war going on. We see what's happening with our currency. We're still volatile. Yeah. And depending on the Forex, to be able to power some of these capabilities also will have impact on our balance sheet heavily. And so these are some of the things where we need to start anticipating and preparing. How long are we going to maintain this kind of behavior for? So at Peerless, we are not just technology providers. We're risk managers or risk advisors. And when I say that, people kind of, well, what kind of risk? We're helping you, not just only to have the right tools, techniques, platforms, people that understands your context, technology that speaks your language, infrastructure that's up to date, but most importantly, agile enough to help you meet customer needs and regulatory requirements. So every institutional architecture is unique. I know we discussed general principle today, but the devil is in the details. And speak to us, we'll be happy to support you. The policy we discussed today here are not the end. There will be more coming in 2027, 2028, and beyond. So you cannot predict every new regulation, but you can build a bank that is ready for them all. You can build a system that is flexible, adaptable, and will have foresight to be able to handle whatever that is coming. I invite you to look at your infrastructure today and ask, is it an anchor holding your back, or is it an engine moving you forward? My team and I, we're all here to support you, to sit down. We'll be working with your CTOs and risk officers. I look forward to the conversation. We want to help multiple financial services in Nigeria, in Africa, to drive the future, using technology as a forefront to make the customers happy, to comply with the regulator, to make profit. Most importantly, to help your balance sheet so that you can be profitable. Thank you very much. And thank you for joining. And please, we look forward to, let's ask questions. And I'm sure Gbenga is here to answer some of the questions as well. Thank you, colleagues. God bless you. Thank you.
Yeah, thank you very much, Dr. Joachim. Thank you for further adding your insights into the conversation this afternoon. Like he said, the purpose of this is not just for today. Regulation is always changing, is always evolving. It's a continuous process. And what is important is that you do not have to kind of squeeze yourself in every time a new regulation is introduced. You need to have a system that is nimble. You need to have an infrastructure that adapts all the time. So when CBN comes again with another regulation in a couple of months, are you ready? Would it require that you put some strain on your operational team, on the staff, before you get things done, or you already have a system that can adapt to this instantly? And that is why Peerless is here to support you. While Dr. Joachim was speaking, Gbenga, reached out and had to excuse himself to join a quick meeting, but he's asked that every question that is directed at him should be sent to him via email, and he would send you a response. So if you have a question, I would just implore you to please drop it in the comments, section of this meeting, and we will take every one of them. The ones we can take here will respond through Dr. Joachim, and the ones that are specific to Gbenga will be sent to him, and I can assure you that you get your response within the space of a week, and we'll get it to you. We'll send you an email to that effect. So once you drop your message, if it is specific to Gbenga, just include that in your response, and then also drop your email so that we will know how to respond to you directly. But while we're doing that, I would like to ask if anyone here has a particular question that Dr. Joachim himself can respond to. We can take a couple of them. If your question is directed at Gbenga directly, we will just advise that you put that in the comment section so we can aggregate everything together. Otherwise, you can just maybe signify, and then Dr. Joachim will respond. I'm trying to see if there are any hands or indication anywhere, so I can take that. Okay, so whilst we're waiting, I would like to thank Dr. Joachim once again and Gbenga Adepetu from PwC. Thank you very much. I think what has stood out from today's conversation so far is that the real challenge is not about understanding policy or policy direction. I mean, we know that a lot of people who work in this space understand regulation quite well. The real problem or the real pressure is what I would say, it comes from translating these regulatory expectations into everyday operational reality. And this is the gap that this conversation is meant to highlight. How do you close that gap? How do you translate everything that the regulator wants into your everyday operational reality, ensuring that you can meet regulatory expectations through your infrastructure at every point in time? And for institutions that want to make, this move or take a more structured step forward after this conversation today, I want you to know that we here at Peerless are ready to have that conversation with you. We're ready to consult with you directly and get you from point A to point B, or to the point where you are going to have that readiness, that structural readiness to adapt to every regulatory change that might come. And I will be dropping a link in the comments now. Please just signify that you can see that link. Yeah, it's a form. What I want you to do is, in case you're an organization that is interested in taking this conversation further, there are two options available in that form. The first is like a core readiness assessment. If you would like to evaluate how well your current core infrastructure supports regulatory alignment, I would advise that you kind of just fill that form. We're happy to do that with you. And just to check how well your core currently supports regulatory alignment, compliance reporting, or even operational resilience. It is totally free to have that conversation, and let's even look at it. How well does your core support your operations today when it comes to regulatory alignment? And if you would also like to have a conversation further with Dr. Joachim on a risk point, from a risk point of view, as to some of the conversations we've had today, we would also encourage that you fill that form as well. And you can book a 20-minute or 30-minute session anytime from next week to just sit down with him and understand certain risk areas that you also need to pay attention to, and how that also can seep into your operational reality. So whichever one is more convenient for you, and we've created that form for you to be able to fill it. We believe that with quality infrastructures, institutions like yours will be more confident in navigating regulatory changes, right? And if you'd like to learn more about the work we do here at Peerless, we are inviting you to please visit our website, bpeerless.co, and you can explore some of our platforms and insights into what we do. And we are happy to support you as a financial institution. You can also follow us on LinkedIn. We are also known as Peerless on LinkedIn. So once you search for us, you'll find our page, and we share a lot of industry's perspectives on financial infrastructure, regulatory readiness, and digital transformation across emerging markets. So we invite you to follow us and get familiar with what we do. Once again, whilst we're waiting for other people to drop their questions or fill the form, I want to appreciate everyone who has taken time to join us today. Thank you so much. We know how precious your time is for you, and we are glad that you've shared a bit of that time with us this afternoon. We look forward to continuing the conversation with you anytime. So again, I'm encouraging you to please fill that form. It's totally consultative, right? No pressure at all. So we'd like to have further conversations with you. And on that note, I would like to bring this conversation to a temporary end, because I know this is not the last that we will hear from each other. So, and I will wish you a wonderful rest of your day. Thank you all so much, and enjoy your Thursday. Bye for now.
Thank you, everyone, for coming. Thank you very much. Yes, thank you, Olumide.
Thank you, Doctor.